As private equity owned businesses struggle and potentially default on loans, what would follow would be the credit crunch of the century. That's what my guest here today, Jared Dillian, wrote in his piece called The Next Big Short: Hidden Risks Behind Private Equity's $8 trillion market. I am thrilled to speak to Jared Dillian of the Daily Dirtnap. Jared, great to see you. How are you doing?
Good. How are you?
I'm doing really well. I'm excited to ask you about your latest piece about private equity. So it's an $8 trillion market. That's pretty big. I think the subprime mortgage market, which you make comparisons to by calling it the Big Short, was less than $1 trillion. So 8 trillion private equity, that is a lot. How did the market get so big?
So anybody can get this for free. This isn't something you have to pay money for. You can go to shortprivateequity.com and get it. We have 17,000 private equity firms in the United States. There's more globally. Private equity firms now have 8 trillion under management. So to put that in perspective, the S&P 500 is 50 trillion. So it's almost 20% of the S&P 500 and growing. The first publicly traded corporation was the Dutch East India Corporation from 400 years ago. I think that was an incredible financial innovation. And really what we're doing is we're going backwards to the time before you had publicly traded companies. I think we're actually going backwards. Private equity buys private firms with significant amount of leverage, okay? And that leverage is applied to the portfolio companies. What happens is, and this is really my biggest problem with private equity, if you're a founder of a company, your time horizon is basically infinite. You want the companies to succeed, but you want it to outlive you. You want it to basically exist forever. If you're a private equity manager and you buy a company, your time horizon is 3 to 5 years, right? And your goal in those 3 to 5 years is to improve the financials enough to take it public or sell it to somebody else. Typically, what that means is cutting costs and raising prices. And that's the one formula that private equity has. Whenever they take over a business, they cut costs and raise prices, they improve the bottom line, and they sell to somebody else at a higher multiple. Okay. In the process, private equity has ruined a lot of businesses in the process. I don't think that a 33-year-old private equity manager really has any particular skill at running a business that is outside of their area of expertise, whether it's a restaurant or an oil company or whatever.
Why do you think private equity has performed so well? I mean, I know some of these flagship funds have IRRs, internal rate of return, of 20%, 22%, less after the fees.
So I think the main reason that private equity has been successful is actually the lack of liquidity and the lack of mark to market. Okay. And I think people have come to view that as an advantage. I don't think it's an advantage, but people have come to view that as an advantage. So on the demand side, if you're an endowment, if you're a pension fund and you give 40 million bucks to a private equity firm and you lock it up for 10 years, you don't really know where it's marked. You don't know what it's worth. At the end of 10 years, you get a big pile of money. There's an internal rate of return, and people are happy with that. People are less happy with buying publicly traded companies and watching their values fluctuate, which causes them stress. I mean, you know me, I wrote a whole book about financial stress. So I think this lack of liquidity has been viewed as an advantage. Okay. I think and also keep in mind, private equity has grown a lot in the last 16 years. We've also had a bull market in the last 16 years, going back to 2008. So the value of public firms have gone up, but the value of private firms have gone up as well. Private firms back 10 years ago were trading at 4 to 5 times EBITDA. Now they're trading at 10 to 12 times. The valuations have increased. And that's one of the reasons why there's a lack of exits, because the IPO window is mostly closed. And for acquisitions, there's really no appetite to buy a private company that's trading at 12 or 14 times EBITDA. So valuations have gone so high that PE firms are finding it difficult to exit.
Yeah, so private equity firms, they take investors' money, they take it from endowments, they take it from pension funds, high net worth individuals. A lot of people's money may be in private equity even if they don't know it. And they buy companies and they use the money they raise as well as borrowed money to purchase those companies, and then they improve those companies and aim to sell them later. And so you're right, they can sell them either to an initial public offering, they take the company public. Sponsor to sponsor means one private equity company sells it to another private equity company, or sponsor to strategic. They sell it to a strategic buyer, a company that wants to acquire that company. Needless to say, 2020 and 2021 was a banner series of years for private equity because rates were very low. There was tons of IPOs and valuations just surged. So tons of money flooded into private equity and the returns looked very, very good. Let's start the clock at January 1st, 2022. In a few months, in March 2022, the Federal Reserve raises interest rates. Tell us what happened to private equity over the past 3 years, because you've documented it very well in your piece with a lot of interesting statistics.
Basically, the returns are going down, right? And I think, I mean, look, like one of the things you said at the beginning of this is that I said that private equity would collapse, and maybe it collapses and maybe it doesn't. I mean, some part of that is hyperbole, right? Like, I think there's a range of outcomes here. I think private equity could collapse and it could cause a recession, a very bad recession, or we could just have a period of, below normal returns in private equity, 2, 4, 6%, maybe flat, and people become unenamored with the asset class and it loses assets over time and it doesn't really have any systemic effects. So I think there's a range of outcomes here. The returns are starting to go down. Higher interest rates are bad for private equity, and you saw interest rates go up in 2022. Okay. And they're starting to go up now. So higher rates are bad for private equity. I think we're going to get higher rates in the future. I'm very bearish on the bond market, and I think it's going to be bad for private equity. But basically, the returns are going to be bad. And one of the reasons private equity has been so successful is because of the demand side. Money is flooding into the space from endowments, from pension funds, from high net worth individuals. And, if you look at the dry powder of the private equity industry, it's in the hundreds of billions of dollars. They have money they can't find a place for. They have to put it to work. And there's competition for these deals, which are terrible deals at really, really high valuations. They've rolled up car washes. They've rolled up bowling alleys. They've rolled up smoothie stores. Like it's to the point where you really can't go anywhere in your daily life without encountering some business that is private equity owned.
Jared, just go back to my original question. Tell us that, so returns are going down, interest rates went up from 25 basis points to 5%. And when you borrow money, you don't want interest rates to go up, especially if you have floating rate debt. It's my understanding that the vast majority of floating rate debt in private equity funds is floating rates. And I don't know how much they hedge their risk. It's really, not available to someone who's not an investor in private equity deals, which I'm not. But I know that the vast amount of bank loans and private credit loans, which are funding these funds, are floating rates. So they suffer as interest rates go up. And that's why you've been hearing about this golden age of private credit, because you want people to get in on the other side. Instead of owning the private equity companies, you own the loans that are floating rates. So rising interest rates was bad for private equity, good for private credit. Falling interest rates, we had a 50 basis point cut in September. We're probably going to get some more cuts from the Federal Reserve. That's good for private equty, and in my opinion, kind of bad for private credit. But we'll see. I mean, it's good for delinquencies. Like delinquencies will go down, but it's just a fact that they're getting less money. Jared, when you say interest rates are going up, I presume you mean the 2 years going up, the 10 years going up, which are basically the Fed funds cuts that are priced into the market won't happen, and therefore forward interest rates are too low, and so they will rise. I don't think you mean the Federal Reserve will raise interest rates on the short end. No. And the floating rate loans, they pay 3 months SOFR, so it really is all about the short end. So do you think that falling interest rates, like the 50 basis point cut, did that help private equity?
I mean, since the rate cut, the yield curve has steepened massively, even in the front end. 2-year yields have gone up. Bond yields have gone up a lot. It's funny because the average person on the street hears that the Fed is cutting interest rates, and then they see mortgage rates go up 40 basis points, and they're like, what the hell is going on? People don't really understand transformations of the yield curve. So even though the Fed has cut 50 basis points, first of all, I don't think they're going to cut a lot more. Like the data has been pretty strong. We had a really strong payroll number. We had a blowout payroll number. I think the data is going to continue to be strong. I think they're going to cut in November and maybe once more in December. I think the most they're going to do is 100 basis points. I think the election, no matter who wins, is an inflationary force. I think the Fed's going to be dealing with inflation by the end of 2025. So I don't think they're going to cut much, and I think they're going to have to hike more later.
Yeah, so mortgage, a lot of people borrow at the longer end of the yield curve. Private equity companies primarily borrow at the short end. So their borrowing costs will go down, but just not as much. You're saying that you don't think they'll go down by as much as is currently priced into the market. Okay, so Jerry, so right now we've got a lot of dry powder, so money that's been raised but hasn't been deployed. Tell us about the money that is given back to investors. You got this great chart of global fund buyout capital contributions and distributions. And it appears that the distributions are going down.
Yeah, so basically, when a PE firm sells a company, they get cash. Usually, they get cash. Um, and that cash is usually distributed to LPs. Okay. So, along the way, over the course of the life of a 10-year PE fund, um, LPs will get distributions of cash, like in dribs and drabs. That hasn't happened. There's very few exits these days, so these distributions have dried up. And in some cases, LPs have been forced to put in cash. They've been forced to contribute cash, after the fact. I think if you're an endowment and you have 30%, 35% of your money in this thing, and you start to ask yourself, like, it's not spitting out any cash. I'm not getting any distributions. I have to put money into it. What the hell does this thing do? I think over the next 3 years, I think there's going to be, people are going to reconsider some of these huge allocations to PE in their endowments.
And what do you think is going to be the catalyst for that reconsideration?
As always, it's going to be returns. I think the returns are going to suck. And I think expectations for returns are very, very high. I think people have gotten used to earning 12, 14, 16% after fees. I'm not alone in saying this. I mean, even John Gray of Blackstone's has said that he thinks returns of PE is going to be much lower in the future, in the range of 4 or 6% or something like that.
So wait, Jerry, I totally take it. John Gray said returns will be lower in the future for PE. But did John Gray say that private equity firms' returns will be 4 to 6%? Did he
No,
say
he
that?
didn't say
Yeah.
that.
Okay. Yeah. Okay. Just wanted to.
Yeah,
Yeah.
yeah.
You're saying that. Got it. And just because it's private, the valuations are reported by the private equity company, and the S&P down, I mean, peak to trough more, but let's say 18% in 2022. I know Blackstone had some funds that they reported they were down 0% in 2022. So maybe the S&P companies were undervalued. The recent market performance would suggest that, but when the stated returns of the private equity firms are higher than the market, they then have a higher valuation, and they might be a little bit overvalued. So the valuations of the private firms lags the valuations of the public
They
market.
do. I do want to make a point about that, though. I mean, ultimately, private valuation should mirror public valuations. Like, I made a joke on August 5th when the market crashed. We had that little mini crash and the VIX went up to 60. I
Mm-hmm.
joked on Twitter that private equity was unch that day. like, but having said that, if if the stock market goes down 20%, 30%, you should have private valuations come down along with public valuations.
Right, but for one day they should. You don't think Blackstone should send their clients an emergency alert? The stock market is down 8% today. We're marking our book down 8% because a month later, probably a week later, the market was higher.
Yeah, and this gets back to the whole time horizons thing, like this mismatch in time horizons. Like the private PE firms think about 3 years, 5 years, 10 years. Somebody who invests in the public market thinks about today, an hour, a minute. So it's just a mismatch in time horizons.
And so, Jared, is your prediction just substantially lower returns, or do you think that there could be a real blow up? Because I mean, you call this the bubble of all bubbles, and you say that if things really started to break in private equity, it could trigger a cascade of effects across the financial system. What would follow would be the credit crunch of the century, and the jobs of 11.7 million people would be in jeopardy. That's the number of people who are in jobs that are in companies that are owned by private equity. So I understand your case of just underperformance. It's too much money has flooded in. The deal qualities are bad. The valuations have gone up, and returns are going to be way lower than they were in the past. I totally get that. I could definitely see that. Uh, tell us how you get to the case of this being the next big short and causing
Okay.
a global financial crisis.
So I lived through the global financial crisis. I lived through the housing bubble, and I have a quote, and I like to say that to err is equities, but to really screw things up takes fixed income,
Mhm.
right? And if you go back to the dot com bubble, the stock market went down 50%, and we had this teeny tiny recession, and people lost a lot of money, but it didn't really have a huge economic impact. The housing bubble was different because there was a lot of debt, right? And anytime you introduce a lot of leverage into the system, that's where the danger is. So I'm concerned about the application of leverage and if it unwinds. So I said one scenario is, the PE firms kind of have a period of lower returns and they kind of earn it out over time. And look, one thing I want to point out, I don't think private equity would be the catalyst for a recession. I don't think private equity is going to blow up exogenously. Okay. What I do think will happen is that we could have a recession and private equity will exacerbate it enormously. Okay. Why is that? Well, the financial crisis was really over in 21 months from the summer of '07 to March of '09. It only took 21 months and we were done. When you're talking about PE firms selling businesses, it's because of the illiquidity, it's going to take a lot longer to sell a portfolio of companies, 17,000 private equity firms selling their holdings. It could depress valuations, public valuations, and private valuations for a period as long as 5 years. So I think the effect of this is that if we have a recession, the next recession will take us a lot longer to come out of because of this liquidation of illiquid assets.
Describe how you think a recession would impact private equity companies and why you think it would just be so bad. So I guess the private equity companies, their businesses suffer during a recession, their profits go down, they're making losses. What happens next?
So, one thing I'm trying to figure out um, is if there's any mechanism for an LP to request a redemption. I like to say liquidity finds a way. If you are the Harvard endowment and you have 39% of your assets in private equity and the stock market goes down 20 or 30% and PE valuations start to go down and you start losing money on your PE piece, can you request a redemption? Can you get out? Really, what I'm concerned about, as a markets guy, as somebody who's traded for 25 years, what I'm concerned about is forced selling. If there's any mechanism that's going to cause forced selling in private companies, it could be as simple as Harvard gets to the end of a 10-year PE fund and they don't roll it over and they take their money out and they invest in something else. I don't know. I don't know what it's going to look like. But like I said, the amount of leverage that's involved here is what makes me nervous.
Each deal may be less levered, but the amount of leverage is higher in the system. You cite a Federal Reserve paper about how in 2000 there was about $40 billion in the private credit industry, and now it's 1.7 trillion.
By the way, 1.7 trillion is about the size of the high yield bond market.
Yes, the high yield bond market has shrunk tremendously, and
Yeah.
people are still talking about the high yield bond market as if it's 20 years ago, and that is where the risky companies are being financed. They're not. They're being financed in the leverage loan market or the private credit market, and I think it's kind of like a waterfall of the worst deals from the high yield bond market get refinanced in the leverage loan market, and then the worst deals in the leverage loan market get financed in the private credit market, and that's why when people say that they're worried about high yield but they like private credit, it's like, well, you like something that's so much riskier. That's the worst credit. Sure, you say you don't talk that much about private credit, but I mean, you got an entire piece of it, and this is, as you're right, the buzziest corner in Wall Street, and a lot of the private credit is lent to private equity companies, and a lot of the private credit companies and the private equity companies are owned by the same company. So they have a private credit firm, they have a private credit operation, they have a private equity operation. Let's say you and I both have a private equity company. I've got my private credit arm lends to your private equity arm. Your private credit arm lends to my private equity arm. It's quite a nice operation we have, don't we?
Yeah.
But Jared, that is one thing I also struggle with, because the great financial crisis, you had forced liquidations, you had investors pulling their money Basically, it was callable money at any time. Lehman Brothers, where you worked, Bear Stearns, financing themselves in the repo market, the asset-backed commercial paper market, where basically they had depositors who were funds who could pull their money at any time, and when they did, it caused a massive cascade. My understanding, Jared, and I could be wrong, I really don't know, is that the lockups for private equity are quite long. I think earlier you said 10 years. So how does this cause a uh, true financial crisis where I have to sell and then my selling drives down the price and then you have to sell and then other people have to sell and then everyone has to sell into a falling market, and that is how you get asset values going down 80-90%. It's not necessarily because of the fundamental reasons. How do you get this fire sale? How does
That
a fire
is
sale happen in private equity?
that is the question. If we could answer that question, we would have the answer. I don't know the answer to that question.
I appreciate your honesty. So how are you constructing this short? You said it's it's the big short. How are you shorting these companies?
There's only a couple ways you can do it. There's four big publicly traded PE firms. There's Blackstone, KKR, TPG, Apollo. There's some other smaller ones, but they're not very liquid. And you can short them, right? They all have different aspects. Like KKR is mostly private credit. Blackstone has a lot of real estate, right? So that's not really a pure play on private equity. Blackstone is the most liquid. The options are very liquid. So, I mean, you could take something like a Blackstone, and by the way, I am short Blackstone. You could take something like a Blackstone and use it as a proxy for the whole PE industry, and it would probably work. The thing is that with 17,000 private equity firms, we could go to 3,000. And the big ones are going to be the ones to survive. It's really going to be the smaller private equity firms that go out of business. So it's tricky.
It is tricky. So I didn't know that TPG was publicly traded. Thanks for letting me know. It's pure as it went public 2 years ago. The Carlyle Group is also a massive one. I have interviewed them, and they manage a lot of money, and they are also publicly traded. I guess the issue is, there an issue, Jared, that the real, let's, for lack of a better word, crappy private equity companies are the small ones that are not publicly traded, and you're kind of shorting the best private equity
That's
companies.
yes, 100%. Yes,
Yeah.
that's the problem. Yeah. I mean, with the financial crisis, there were some publicly traded mortgage companies that were crappy. If you remember, like New Century and stuff like that, like there were vehicles you could use to short it. This is tough. I mean, the one thing I tell people is that, look, like, this may not be, in terms of the big short, like, this may not be a trade that you can really implement to have a trade like the big short. But this is useful information for a number of reasons. Okay. If you own a business like an HVAC company with 40 million in revenues, maybe now is a good time to sell that business and not 5 years from now. If you're 62 years old and you're thinking about selling, you should sell now instead of 5 years from now, right? So that's useful information. The one thing I will say is that, the first time I heard of private equity, the thinking back then, I think if you like Googled private equity and you like just pulled up some basic information about it, it would have said that PE firms roll up predictable businesses with stable, predictable cash flows. So, like, the classic example is like a tobacco company. Like, a tobacco company is it's great to roll up. But now PE firms are buying everything. They're buying stuff that's very pro-cyclical, right? With a huge volatility of cash flows. Historically, that's not the type of business that you would like to buy.
Right. And I was surprised at a shockingly high percentage, shocking to me, shockingly high percentage of companies that were the borrowers of private credit were in the technology sector. You think of capital intensive businesses that require a lot of debt. You think of steel plants and the like, but no, they really are. It is technology companies that are borrowing a lot of money. And you think, if the technology company encounters some difficulty, there's not a lot of collateral, I imagine, right? I mean, I don't know. You're going to take the computers. Like, it's not like you can take the land and the steel plant, right?
Yeah, yeah.
Jared, this piece, you are an excellent writer and a financial thinker, as I know and many viewers know. So this is an excellent piece, and if you like Jared Dillian, you should definitely read this piece. And if you've never heard of Jared Dillian, you should read this. You should read this piece. We'll include a link. But writing a great piece and having a high level of confidence are often different things. What is your level of confidence in this short?
I have 100% confidence that PE returns will go down a lot over the next 10 years. I have 100% confidence in that. I have about 20% confidence that it will result in some kind of financial calamity. I'm also a trader, right? So typically when I put a trade on, I'm not very confident, but when it goes in my favor, I get more and more confident, right? And this idea that I talked about in the beginning, how for many years, we considered liquidity to be an advantage. And now, for whatever strange reason, we considered illiquidity to be an advantage. And I don't think it's an advantage at all. I think as we'll find out.
Liquidity is always a good thing if you have to sell. I guess the pitch of private equity is you don't have to sell. And the reason the clients like it is because they don't experience mark to market volatility, which is another topic that people like getting their report at the end of the month, the end of the quarter, and saying we're up 3%, we're up 10%. And they don't have to experience the August 5th market meltdown. Cliff Asness, quantitative investor, hedge fund manager of AQR, has made this point very well, that it's basically volatility laundering. Private equity is volatility laundering. They're masking the true volatility of the business cycle by not reporting day to day. How
Yeah,
big of an issue do you think this is?
I think that is the issue. I think that is the issue, honestly. The other thing is, as endowments have increased their holdings of private equity to, on average, a little less than 30%, their holdings of public equities have gone way down. So the average endowment is only 8% in public equities, right? So if you can think of a scenario where an endowment needs money, right? We kind of have this demographic bust coming, and there's going to be fewer and fewer students going to college. Like, I can think of a bunch of situations where a university might need cash and they don't have the ability to raise that cash. So I don't know what happens next. Maybe they're borrowing against their PE holdings or what, which is also bad.
Right. And I think it's hard for people to fathom just how different the financial system is and because private credit and private equity firms have replaced a lot of the investing that was done by banks. What used to be done by banks is now done by private credit. And a lot of what used to be done in public markets is now done in private equity. For example, I was on Apollo's website. Their credit business, $500 billion, $502 billion. I'm looking at JP Morgan, the biggest bank in America and one of the biggest banks in the world. I mean, it's the biggest non-Chinese bank, I believe. Their commercial middle market commercial real estate banking is about 400 billion. So Apollo is, in some sense, if you're talking about the business of lending to risky companies that could default, Apollo in a way is bigger than JP Morgan. JP Morgan total loans is big, but that includes credit card and mortgages, which in this current environment, mortgages have very, very low risk.
Well, and you think about that in terms of regulation, like JP Morgan is very, very highly regulated and the PE firms are not. So, money kind of flows to the area where you have the least amount of regulation.
Yeah, Jared, what do you think will be the knock-on effects of the potential implosion in private credit and private equity on the broader economy? You referenced earlier 12 million people are employed by companies linked to private equity, and also the connection to the banking system. If company A, company B goes bankrupt, it does not affect the broader economy that much. If a giant bank like JP Morgan goes under, it has huge macroeconomic consequences. And that is why when Lehman Brothers, when Bear Stearns, AIG, these financial firms go bust, uh, you have a cycle of insolvency that feeds on itself, and it can be really bad. My sense, Jerry, is that from a year ago, if you asked a lot of the regulators, and some of this is from speaking to some people, that they would say that they were not worried about private credit or private equity and as a systemic risk. There's a Yale Center of Financial Stability, a thought leader there, said he wasn't that worried. If Apollo goes down, it's not that big of a deal because it's not connected to the banking system. I think I have learned over the past year that the banking system is increasingly lending to non-bank credit providers such as Apollo and all Blackstone and the like. And I think that maybe the banking and the non-banking system could be closer linked than previously thought. And I'm curious if if we ask those same regulators today what they would say. What are your thoughts here about just the systemic risk of private equity?
I think that's very naive to say, okay, if Apollo goes under, like it happens in a vacuum and it doesn't affect anybody else, and therefore it has no systemic effects. I think it has huge systemic effects, and also because of correlation. If Apollo is having trouble, then they're all having trouble at the same time.
Jerry, I mean, what do you think about the economy? Has the economy avoided a recession, which has been predicted for? I mean, there are people who've been predicting a recession for 3 years, and it hasn't happened. Uh, Now that the Federal Reserve is finally cutting interest rates, and we are not in a recession, do you think that we can safely say we have landed? The economy has avoided one.
In the past couple of years, we've had a couple of periods where the economic data has slowed down significantly, including like late 2023.
Yep.
Um, and I think in late 2023, I was also predicting a recession. The data slowed significantly, and then it got better. Um, I think we have avoided a recession in the near term. I am not bearish on the economy at all.
Mhm.
In fact, I think after the election, there's going to be a burst in consumption. I think people have postponed consumption until after the election, mostly for psychological reasons. The economy is going to run hot.
That makes sense. And do you think rate cuts are going to be stimulative to the economy?
In general, they should be. Look, if the yield curve steepens, it kind of negates the effect of the rate cuts, which is what we're seeing.
Right. Oh, Jared, we missed the biggest thing. Tell us, you as people know, you are a sentiment guy. That is a leading part of your analysis. What is your sentiment analysis of private equity? What signs are you seeing in the media, in financial news that make you say this is a top in private equity?
Look, all the kids want to work there. Everybody wants to work there. Nobody wants to be an investment banker. Nobody wants to be a trader. Everybody wants to work in private equity. I think that we actually reached a sentiment top at the beginning of this year. The top was actually Blackstone's Christmas video. I don't know if you saw that. They made like this music video about Blackstone, and it got leaked to the public.
I did, Jared. I did, Jared. I saw that, and I see why you say that was the sentiment top. But I'm just looking at the chart. I'll assume that was published December 18th, 2023. The stock's up 21% since then. So, do you think it wasn't the top in the stock? Do you still think it's the sentiment top? Because shouldn't the sentiment top and the market top be the same, or maybe not?
Not necessarily. Not
Okay,
necessarily. Yeah. I think that the main reason that the PE firms made a higher high is because rates went down, right? But I think we've had the sentiment top. So
got it. So, Jared, tell us what else. What else are you viewing in the markets?
I think commodities bottomed in August. I think we had a capitulation panic bottom in commodities. Um, September was a great month for commodities, had a big bounce. October continues to be a great month. Um, and this is a really a secular call of mine that we are entering a period of higher inflation, um, and also, if you think about it in terms of the Fed, the Fed is cutting while the economy is still pretty strong. It's kind of a Goldilocks period for stocks and commodities. So, yeah, I've been super bullish on commodities. During the pandemic, commodities rallied, and then it's been a relentless bear market ever since.
Which
Um,
you did a good job, Jared. In September 2022, probably almost exactly 2 years ago, my previous show, Forward Guidance, you predicted that uh, you were bearish oil, and it worked.
I think that was more in like May or June of 22, but yeah.
So, Jared, why exactly are you bullish commodities, and are there particular commodities you're bullish on?
So I think that we are entering a period of time similar to the 1970s. And I do want to talk about politics a little bit. The real danger here is that one of these people gets elected. Both Kamala Harris and Trump are inflationary, just in different ways. On one hand, you have Kamala Harris who wants to control prices on food. On the other hand, you have Trump who wants to have a part in setting interest rates. 2025 is going to be a very inflationary year. We're seeing inflation bottom right now. We just printed 2.4 on CPI, but I think inflation is bottoming. There's going to be some lagged effects because of housing and stuff like that, but I think you'll see significantly higher inflation in 2025 and 26.
Do you think the Biden administration has had an inflationary policy?
Um, Not necessarily. Not necessarily. Um, no, I don't think so.
Some people say it's his policies have been inflationary. I just would say that I feel like who the president is matters a lot less for the economy than a lot of people think.
Yeah,
Democrat or Republican.
that's true. And I mean, really, the source of the inflation was was the stimulus checks that we handed out, and the PPP loans, and the child tax credits, and stuff like that. We pumped about $3 trillion into the economy. We started it under Trump. It started under Trump, and Biden continued it long after it was necessary. So I think both play a role. I mean, Biden gets blamed for the inflation because it basically started showing up in the data after he was inaugurated, right? So he gets blamed for the inflation. But a lot of the source of that actually came from Trump. And like I said, Biden continued it.
Right, and a lot of it was supply chain focused. And I think that the fact that inflation has fallen so much without there being a huge rise in unemployment is a sign that a lot of it was supply. I think I used to be it was mostly demand and some supply. I think I'm probably now in the 50-50 camp. Okay, so you're long commodities and you're short bonds as well.
Yep.
What's your conviction of shorting bonds? I feel like I just was looking at the returns of various hedge funds, and the macro funds are not doing super well this year. And to me, that kind of makes sense because 2022 it was kind of obvious. Like inflation's at 6% and it's going up, and the 10 year is at 1.5%, and the Fed is interest rates at zero. Many macro funds did 50, 100% that year. Not that that was the average, but I feel like now I don't really feel like there's interest rates are going up or down. I feel like it's kind of not obvious. Like, do you?
It's obvious to me.
Okay, okay, tell me about that.
Yeah. So 3 weeks ago, the 30-year bond was under 4%. It was 3.96, right? And you look at this in context of the election, and if Trump gets elected, the deficits are going to get bigger. If Kamala gets elected, the deficits are going to get incredibly bigger. You're going to have more issuance. You're going to get more inflation. The last thing I want to own is a 30-year bond. Now, Druckenmiller at the Grants conference said he was short bonds. He said it was 15 to 20% of his portfolio. He said that George Soros would have laughed at him for having such a small position. If you don't believe me, take some of Druckenmiller's conviction. Like, that is his highest conviction trade, is shorting bonds.
Right. So I'm looking at TLT. So TLT went down to $83, which if it went from 93 to $83 now, it would be a 10% decline. So shorting, that's a 10% gain, but I guess you have to use a lot of leverage to get a good return out of that. Do you think the 10-year goes beyond 5%? Because, if we go 5%, then if it goes beyond 5%, then shorting bonds will yield a higher return. But if it goes 5%, I think it's, you get 10%, which is good. But, it's not 2022 like.
You know how to trade options?
I've never traded options on futures, but is that how you're structuring these trades?
Even options on TLT. Options on TLT are very liquid. You can, extremely liquid. Options on TLT are extremely liquid. And the nice thing about options on TLT is that you can go out until 2027. You can trade very long dated options that are super liquid.
Jared, I have traded options in my day. I can't claim to have a phenomenal track record, to be honest. And I think you are one of two people who I attribute to me stop trading options. The other person I won't name, but I think you said something on Twitter that the options market is transferring money from people who are bad at math to people who are good at math. I'm not good at math, so I've stopped trading options, and I'm much the better for it. But you do trade options, so your short on bonds is not just shorting the futures or shorting TLT. It is using options.
Yes.
Got it. And where do you think the 10-year will be over the next year? Do you think it will be at that 5%, or where?
I think tens will get to 4.5, 4.6, and bonds will get to 5%.
Got it. When you are trading options, you obviously have a view on implied volatility of rates. So you're bearish the bonds, but if you buy puts, you're long the volatility. If you short the calls, you're short the volatility. I spoke to Harley Bassman, very well respected interest rate options trader. he said he likes taking that convexity risk or interest rate vol because he thinks the move index, which is what he created, is overvalued. Do you think bond volatility is also overvalued, or do you think it's undervalued?
I do not have an opinion on bond volatility at all. I don't. And I just want to add that in general, options experts, volatility experts, tend to put a little too much faith in their ability to determine whether an option is rich or cheap. For the directional user of options, for somebody who's just buying calls, buying puts, stuff like that, most of the time the volatility doesn't really matter. It matters at the extremes. It matters if an option is 500 vol. It matters if an option is 8 vol. But in the middle, if you're taking a directional view, it doesn't really matter.
Fair point. When you do trade an option, you are locking in a borrowing rate of an institutional borrow rate that's available to hedge funds. Whereas, someone like me, a margin rate would be like 10%. So you get that cheaper thing. I would say if you're buying TLT put options out to 2027, you definitely, whether you like it or not, are impacted by implied volatility.
Yeah.
Right. Any other trades, Jared? What do you think about the stock market?
Zero opinion on stocks. Not involved at all.
Why do you have zero views?
We've actually been in a pretty tight range since September 19th. We haven't broken out one way or another. What I said back then was if one of the candidates starts to pull away, then you would see a reaction in the stock market. Mm-hmm. Trump is starting to pull away in the betting odds, and we are at the upper end of that range.
Yeah, the market has broken. I mean, we are at all-time highs, right, as we record.
Yeah, but it's been a pretty tight range for the last 3 weeks. Yeah,
it has. Jared, tell us about your latest book, Night Moves and Other Stories.
Yeah, so this is a short story collection. I wrote some of these when I was in grad school getting my MFA. There's 16 stories in this collection. It's literary fiction. It is a phenomenal book. The reviews have been incredible. What are the stories about? Just all different kinds of stuff. Just people in sort of extreme situations. It's a fantastic book. I highly think you should check it out.
People should check that out. I'm going to check that out. Yeah, it does have a very high rating on Amazon. My show, Monetary Matters, has a high rating on Apple Podcasts. But please, people, if you're listening, please leave a review and a rating. Let's keep the ratings and reviews coming. I really appreciate it. You can listen to this show not just on YouTube, but on Apple Podcasts, Spotify, and wherever you get your podcasts. Check out Jared's book. You can follow him on at the Daily Dirtnap. We will link not just to Jared's Twitter, but also to Jared's piece on The Big Short in private equity. Thank you, Jared, for coming on Monetary Matters, and thank you, everyone, for watching.
Thank you. Just close the door.